I'd say 86% is my target for equities, which is the biggest thing we've seen since 1929 and 32. And yes, first half of 2022. My target is this first crash. It's only the first crash of the bigger crash over a couple years. Will probably bottom around July, mid-July. So we're in that first crash. First wave has begun. I think there's now not a big chance we'll see another slight new high. I think stocks are going down and you need to sell on weakness because this is not going to be another correction, okay? People are used to it, the last 30 years, up, correction. No, this is the beginning of a long-term bear market. You have to get kicked hard. I mean, because again, look at this, since the early 80s. The market's only gone up. Yeah, we had big corrections in 87 and 2000, 2002 and 2008 and 9. And it keeps going up. People are now thinking it can only go up. You have to get shocked out of that. You know what the shock is? History shows it, a 40% crash within the first several months. People think, oh, the economy's strong. You know what? The economy's strong. The Federal Reserve's put like $5 trillion of money printing in the last few years and $5 trillion in the government in fiscal stimulus. It's all stimulus. The economy underlying from 2008 to now is weak. So the problem is that when things finally go down, it's going to be stronger than people think because the economy is so weak. Without this stimulus, we'd have nothing. Inflation only leads to deflation in history. We had the strongest inflation in history in the 1970s. People forget that. You know what that was? Baby boomers, biggest generation, entering the workforce in massive numbers at great expense. Young people cost a lot of money to raise and incorporate in the workforce. Now, it's the opposite. We're going towards deflation, and what the Fed is doing here, they're fighting deflation, and they're going to lose that battle. After overstimulating for so long, since 2009, they are now forced into tightening when the economy is a lot weaker than they think. They think, oh, the economy's okay. Well, they printed so much money. They've given people so much free money. It looks okay. As soon as this thing falls, it's going to be stronger than people expect. So I do not think the Fed is going to have tightening. I think the recession, my indicators, 𝐃𝐈𝐒𝐂𝐋𝐀, my best leading indicator, says we're already on the verge of a recession now, not 6 months from now. We're about to go into recession already, and this is after $10 trillion, half of our GDP, of stimulus. How could you stimulate that much and go into a recession again? Why? The economy is the weakest it's ever been, as my indicator said 30 years ago. There's no soft landing here. The Fed is hoping for that. They don't understand the underlying trends of the economy. They just think if they do the right interest rates, no, there's no soft landing here. We are so overstretched. The biggest bubble in everything, real estate, financial assets, everything, even gold has been in a bubble. The economy died in 2007, which I predicted 30 years before it happened. Baby boom, greatest boom in history, growing up, spending money predictably at age 46, now 47, and then we would have a downturn from 2008 to 2023 until the millennials came along and drove us up. They are fighting this downturn when the fundamentals are weak. So they are assuming the economy is stronger than it is. The economy is only strong because of their stimulus. I think stocks already peaked on January 4th. And again, why there's been a succession of tops in major indices, including the US, the small caps, and the NASDAQ around the world over the last year. That is only something that happens at a major long-term top. So I think the market's already topped January 4th for the S&P 500, and we're heading down, and the Federal Reserve's going to find out that their something for nothing stimulus didn't really work in the end, and people are going to find this out only when things crash. I'm telling you, you can find it out now.
Why is gold not the place to seek refuge in the storm?
Because it's a financial asset. It's the king, I would say, of the commodity sector, and it will do very well in the future when we get past this, because India is the biggest driving factor after China. India will be the next China, and Indians love gold. I've never been in a country where people love gold more than anything. Gold is an asset that has bubbled like everything else. All financial, remember I said all financial assets have bubbled. All will crash. Only the treasury bonds, the safest bonds, go up in that scenario, as happened in 2008. I would say in the next year or two, down to 900 to 1,000. And I'm telling you, that's going to look good compared to other commodities and stocks. Stocks going to be down 86%. And then I think gold in the next global boom, which will be dominated increasingly by Southeast Asia and India, and they love gold. I think gold could go to 3,000 to 5,000 in that boom, but not in the bust. People think Bitcoin's a safe haven. Bitcoin's the biggest bubble here. New industry. They think gold's a safe haven. No, gold is not the safe haven. I have an inflation indicator. It's workforce growth. You know what costs money to the economy? Young people. Anybody have kids? They cost and produce very little, okay? We had the greatest inflation in the 70s, not because of bad government policies or deficit, it's because the baby boom entered the workforce. Now we have the opposite. We have deflationary tendencies as baby boomers die faster than millennials rise in their spending. We've never seen a smaller generation follow a bigger one. We've never seen this before. So that's why they have to stimulate so hard, because the millennials, yes, they're going to start spending, yeah, but the baby boomers will continue to spend less until they die by 2042. I can put a number on anything you want to put. When people spend the most, die, anything.
Wait, so 2042, what's that?
That's when the last baby boomers will die on average. So the trends, even though people say, oh, Harry, the millennials are going to come. The millennials are not anywhere near the size of the generation, the baby boomers. The baby boomers caused the greatest boom in history, which I called in the early to mid 80s, from 1983 to 2007. And ever since, why have they been stimulating so hard and more and more and more? Because you're fighting a downtrend. Biggest generation in history is dying. It's the everything bubble, so you have to be out of everything. There's only two things to do well in a crash when everything goes down: stocks, real estate, commodities, everything, including gold in the end. Treasury bonds. The safest long-term bonds, 30-year treasuries from the United States government, will be the safe haven. Is the U.S. government is the United States going to go into recession? Yeah, but we're the best house. We have way less money printing than Europe and way less more than Japan. We're the best house. Our bonds, 10 30-year treasury bonds, will be the safe haven. Gold will not be. And I'm in a conference where everybody thinks gold's going to be the safe haven. Not. It wasn't in 2008. And treasury bonds did go up when everything went down in 2008. Most people don't own that much in financial assets like stocks, in their 401k plan. They own some. Everybody owns real estate in the United States. Everybody that can afford to does. The millennials are going to kiss the ground when this happens, what I'm saying, because real estate will go back down to 2008 to 2012 levels, the lows we saw after the last crash. And remember, stocks crash quick. Real estate took years to hit a bottom, really mostly 2010 to 12. Real estate will go down at least to those levels and become affordable to the millennials for the first time in their life. They're the winners. Guess who the losers are? People like me, baby boomers who've invested in real estate and keep saying you can't go wrong buying real estate, own real estate, and real estate goes down. Now, last time, 34%. Even the Great Depression, 26%. This is the biggest decline. This will be 40 to 50% in real estate. We've never seen that before. That'll be a shock.